Hi, everyone. Welcome to the latest Take 5 with Ryan and Sonu. We're telling this one why things really aren't that bad. Sonu, you think about the headlines. They have been very, very negative the last, 2 or 3 years, I guess you could say, right? It feels like there's so much negativity. Just recently, Bill Gross, who used to run PIMCO and one of the biggest bond names out there, said there's a recession coming by the end of this year. And there's a lot of other people that have been piling on the recession call. It feels like every week we do one of those videos and you're pointing out, listen, there's no recession coming. You've done a little bit more work. I'll set the table for you here. The NBER, that's the company. Those are the people that call it, right? Call a recession or not. There's 6 things that they look at. And I do want you to actually say what the NBER stands for in a second. But there's 6 things they look at that if there's a recession or not. So tell me, how close are we to a recession with their own instruments they use?
We're not close. Short answer. But NBER stands for National Bureau of Economic Research. They have something.
There you go. I knew I could have maybe got there, but I wanted you to do it. So nice job, Sonu. You get a star for the day.
I'm glad I didn't prepare for them. No, I knew what that was. But so you copied a good one there.
Yeah.
But look, they have something called the Recession Dating Committee, and they don't really look at GDP. You think they look at GDP,
right.
like you've heard those things, 2 quarters negative GDP. No, I mean, that's not how they say, okay, the economy, usually it's after the fact, right? It's not before the fact, right? It's not even during the recession. They call it after the fact, right? Back in 2008, they called it in 2010. They said, the recession started in December 2007 and it ended in June 2009, right? So they look at 6 indicators. 2 of them are from the employment labor market data. So we know payrolls have been strong. Unemployment rate is down. So that's strong. That's 2. Then we have the household sector, right? Consumption and income, right? Consumption's running blockbusters, right? After adjusting for inflation last 3 months, consumption's running around 3.5-4%. That's huge, right? That tells you underlying growth for the economy. Real incomes adjusted for inflation, that's also running pretty much close to, pre-pandemic pace, right? Just under 2%. And by the way, Ryan, for that, we're going to get another tailwind because gas prices are coming down. In several states across the country, you're going to see gas prices under $3 a gallon. So that's going to be big for consumer balance sheets, household incomes, right? Then you have the business side, right? Wholesale trade, retail sales, how much money businesses are making, and then production as well. Industrial production is running, get this, 5% over the last 3 months, right?
Wow.
And before the pandemic, it was flat. The 2018 to 2019 pace, we talk about that as a strong economy. Manufacturing wasn't doing as well. 2018, 2019, production was flat. Now production's running at a 5% annualized pace. That's real, right? That's inflation adjusted, by the way.
So let me jump in here. So the bottom line, the 6 things that are looked at to determine if we're in a recession or not are pretty much saying wildly there's no recession. So that's some good news that's out there. Also, Sony, let's talk about this. We have had a pretty good size pullback in the market. We know that in August, September, the first part of October here, close to double digits. If you look at the S&P 500, some other areas have pulled back double digits. Listen, your average year sees about a 14% peak to trough correction. So we haven't even seen that yet. And in the full context, most stocks are still up on the year. A lot of stocks are still up on the year. Yes, there are some, your more defensive areas, your utilities and staples. Some of the more defensive areas haven't done very well as yields have gone higher. So people haven't really invested in those because they tend to pay a higher yield. So they just go, take some money in a money market account and they're safe with it. But the bottom line, the stock market has pulled back, but we're still optimistic. As you just laid out, the economy's strong. Historically, fourth quarter does pretty well. We really think we're going to make another October low, a la last year and a lot of other years where October, you tend to see this really scary bottom, but then upward bias. We think that's possible. That's some other good news. So we have about a minute to go. Let's talk a little bit more about the consumer, right? Talk to me. You've done some really interesting research on some data that the Fed just released and how much people are worth. Maybe this is another reason we haven't had a recession. You got about a minute.
Right. So the Fed releases something called the Survey of Consumer Finances. This is like the gold standard. They do this every 3 years.
Yep.
And the results are stunning, right? But in a sense, that explains why the economy is held up and defied everyone else's prediction of recessions over the last 2-3 years, right? Real median net worth, right? So after adjusting for inflation between 2019 and 2022, so this is after that big surge in inflation. That surge 37%, Ryan, 37%.
Wow.
And then if you look at home ownership rate, that's at, close to an all-time high of 66%. That's really high. And then you think about, okay, let's look at housing value, right? Net housing value. So the total amount of your home, the home value, minus the amount of debt which you owe to the bank, that's increased 45% for the median homeowner. That's an 45% increase in wealth just from the home, right? And a lot of, less wealthy people, actually, a lot of the wealth is in property. And, that's a good sign that property prices are increasing. I mean, it's not great for the housing market for people looking for new homes, but, most people own 66% of households. Their wealth has gone up, right? And then a final one, they have a measure of financial fragility. So it's basically the median leverage ratio, families' total debt relative to total assets. That's fallen to a 20-year low of 29%, right? And the median payment to income ratio, so how much you're paying for debt relative to your income, that's the lowest level ever recorded in the survey, 13%, right? So I'll just leave it at that.
Well, no, that sounds like a good way to leave it right there with the latest Take 5. Things really aren't as bad as they seem is the bottom line. We'll see you right next time. Take care. Thank you.